Hello, Mark Ostwald from ADM Investor Services International. This week I'd like to share some thoughts on ECB policy outlook and, by way of a contrast, the Fed policy outlook in the US. The ECB meeting yesterday was, on balance, a slight over-delivery, as is typical of Mario Draghi. They made some very sharp downward revisions to some of their forecasts. Above all, their forecast for GDP this year was cut from 1.7% down to 1.1%. The outlook was also lowered for the years ahead. We are now looking at 1.6 and 1.8% in the next 2 years. And we've also had a quite drastic cut to the inflation forecasts this year. We're going to have inflation, according to the ECB, at 1.2, and then it picks up and flatlines over the next 2 years around 1.6, while core CPI is also expected to be lower than originally, gradually rising, but only from 1.2 to 1.6, which basically justified their decision to, first of all, push back on their rate trajectory. They've only pushed it back to the end of December. That's largely because we've got a change of the guard at the top of the ECB at the end of October when Mr. Draghi is replaced. And therefore, he doesn't want, I think, to prejudge policy thereafter. And we've also got these new round of targeted TLTROs. Right, there are a couple of issues here. First of all, it is obviously quite ironic that having just ended QE in December of last year, they're now having to enact further measures. Nevertheless, Mr. Draghi made it very, very clear, and despite the obvious protestations of the more hawkish members, that while the decision was based on the economic forecasts, it is primarily, these TLTROs are primarily aimed at ensuring that there isn't too much of a drain of liquidity from the banking sector. And one can see, first of all, on the next table that we've got basically nothing in the way of rate hikes priced in before the end of this year, and we are unlikely, I think, probably to see a rate hike before Q2 of next year. That may change as the year goes on, but for the time being, it seems an unlikely prospect given those forecasts. Secondly, and just as importantly, we also need to have a look at the ECB's balance sheet, which I've got a table of on the next one. As one can see, since they ended QE in December, we've seen it starting to shrink. It is obviously still absolutely enormous, 41% of total Eurozone GDP. And per se, it's somewhat disappointing that with so much QE in the financial sector that we're not doing very much. And that brings us to the nub of the matter with the TLTROs. Will they give a meaningful boost to lending? Probably not, no more than the QE has. And that's largely because the ECB, in contrast to the Fed and the Treasury in the States, hasn't been able, because of these are all national political decisions, to force balance sheet reconciliation on the banking sector. Therefore, a lot of the time, QE or TLTROs are basically there to prop up the banking sector. So the stimulus from this is likely to be minimal, and it really does reflect the concerns of the ECB. By contrast, if we have a look at the final table, the Federal Reserve is still not expected to hike rates this year, though I think the signals at the moment, obviously much depends on what happens with inflation data, which we'll be getting next week, which is expected to be quite neutral, and with the labour market. The signals are still probably that the next move in rates is probably likely to be higher in the US, by contrast with the ECB, where it's likely to be much lower or lower for much, much longer unless things start to improve in the Eurozone economy very meaningfully. And for that, we need a lot of structural reforms by the politicians.